Right. So good evening again. Uh, as we have informed already, in this session, we are going to discuss a question on company taxation. So we have picked a similar question, what you will get in your final exam, kind of a similar question. So we have uploaded this question already into the LMS. You can download it. So I request you to download the question separately, not just getting the or reading the question from the screen. So download it and you can go through this whole question when you are trying to develop the answer. And we will read the question fully once because you need to be familiarized with a company taxation question. Then after that, after practicing, you can understand what are the things normally included in a company taxation question. So last week, actually, you discussed an individual taxation question. Now I think you know how to tackle an individual taxation question. Now this is about a company taxation one. Right. So I will read the question with you. You can read, or you can, if you have a hard copy by any chance, you can underline, you can highlight the important things, or even in the screen, you can mark these things, highlight your important things. Right. So we'll start the question. Sand Beach Hotel, a private limited, SBH, operates a hotel business in Waskaduwa with the approval of the Ceylon Tourist Board. So basically, this business talks about a hotel business that you need to understand. The extracts of the draft financial statements of the company for the year ended 31st March 2026 are as follows. Now, with the activities you have done in your lecture, you know that most of the time your year of assessment would be 2025, 2026. So that is why we have, even though we have not reached 31st March 2026 yet, we have taken the latest year of assessment for your reference, right? So that is why we have developed the question like this. And then you have these extracts of the financial statement. You can see values are in thousands, revenue figure, cost of sales, and then you have taken gross profit after deducting the cost of sales, and then you have other income, and you can see a separate column is there for some notes. So note number 1 will reflect other income. So you have to be very careful when you are reading the notes. And then we have distribution cost. So that starts the expenses actually. Note number 2. And then administrative expenses, note number 3. And then there's no finance cost in this example. So there's no note as well. And then other expenses, note number 4, after deducting, that means after adding other income to the gross profit and after deducting distribution, admin, and other expenses, you have the final number, profit before tax, because we have not deducted any taxes. Profit before tax has 66,515 in thousands. So this is how the extracts has been given. Right now, as you can see, there are several notes. Note number 1, that is about other income. So this is the note number 1. So there are plenty of items coming under other income. Rent income, 3,480. Now you can see in note number 1, coming under rent income, again you have Roman numbers, different sub notes, so that it says refer 8. That means another, I'll show you. After that, there are some additional informations. So when we go to Roman number 8, the composition of rent income is as follows. Likewise, you have subnotes given. So that is why it is very important to read these main notes and then the subnotes, right? Roman number 8. I'm not going to read them. We will just see what are the things covered under other income. And then you have, apart from rent income, you have dividend income. Again, you have a note number 9. And then cash prize awarded by Ceylon Tourist Board identifying SBH as the best hospitality service provider of the year. That's a cash prize. Again, there's a line item slightly. And then you have profit on disposal of P-bus, refer to note number 3. So they have a asset disposal, PPE disposal, a minibus they have disposed during the period. And this accounting profit, right? We are talking about the financial statements. So this accounting profit has been added as another income, right? We'll see what we can do. And then note number 2. Note number 1 is done. So note number 2 is about distribution cost, isn't it? So note number 2, distribution cost, coming under that you have bad and doubtful debts. There's a note again, refer to note number 5. And then you have advertising, you have depreciation as well. Now, what is this depreciation? This depreciation is related to distribution expenses. So if I give you one example for this one, maybe there are distribution related vehicles. Depreciation expense of those distribution related vehicles can be taken as depreciation under distribution cost. So likewise, you have depreciation cost, accounting depreciation. And then that is about note number 2. And then you have note number 3, admin expenses. So administrative expenses, you have salaries and wages paid, EPF, ETF. Again, you have depreciation. Now, as per the explanation I gave you when it comes to distribution, admin also, this depreciation is what? Depreciation expense, accounting depreciation related to administrative PPEs, like administration purpose PPEs. Maybe there's a building. If the company has a building, then it can be depreciation coming under administrative expenses. Likewise, there can be some of machines or equipments used in the head office. Likewise, assets we have used for administration purposes, when we are depreciating them, depreciation is there coming under administrative expenses. And then you have utility expenses, electricity, water, internet, and all. And then you have a fine paid to the tourist board. This company has paid a fine to the tourist board. That is also there coming under admin expenses. And then you have vehicle maintenance. Vehicle maintenance total is 6,000. Coming under that, you have 2.44 million was spent on cars. Okay, so out of 6,000, 2,440 has been spent on some cars. So we don't know about the cars yet. We'll go through the whole question, then you will understand. You need to remember this, memorize this. And then you have staff training coming under admin expenses. Refer note number 6, 900. Okay, so that is about admin expenses. And then you have other expenses. Right? Sorry, other expenses. Other expenses is note number 4. Note number 4. Coming under that, you have donations. That is again, refer note number 10. And then entertainment expenses are there. Note number 7. And then provision of lawsuit. Again, there's no note, 100,000. And then annual get-together expenses of the staff, 900. So those are the other expenses categorized in this question. Okay, so we have covered the main 4 notes, right? Note number 1, 2, 3, and 4. We have covered the main notes. Now we have another important note in any financial statement set, PPE note, property, plant, and equipment. Right, as you can see, we have been given the cost or the valuation details starting from the opening balance. That means balance as at 31st March 2025. That is the opening balance. And then if there are any additions and any revaluations done during the period and any disposals during the period. And then finally the balance as at 31st March 2026, year-end balance. Similarly, you have accumulated depreciation as well. So the opening balances, depreciation during the period, any disposals. That means if there are any disposals, how you have removed depreciation, and then final balance of the accumulated depreciation. The last row is about the carrying amount. So after deducting accumulated depreciation from the cost or the value, you have the carrying amount as at 31st March 2026. So that is about the rows. Now, what are the columns or asset types they have in their PPE note? They have lands, they have buildings. So in that land, you can see there has been a revaluation. Since we are not depreciating, no depreciation coming under lands. And then buildings, they have 400,000 opening balance. They have an addition during the period. 150,000, and then opening balance of accumulated depreciation, and during the year depreciation, and then the balance, and then finally the carrying amount. Machinery, they don't have any additions or disposals during the period. They just have the current year depreciation added. And then motor vehicle, they have additions during the period, and also they have one or multiple, and we don't know yet. Disposals are there. 9,000, that means 9 million worth of disposals are there coming under motor vehicles. And then when it comes to accumulated depreciation, they have the opening balance, they have the current year depreciation, and this is what, when we are disposing the assets, we have to reverse. So we have to remove the accumulated depreciation. So that accounting accumulated depreciation has been removed from the PPE note, and then the final balance of accumulated depreciation, and then the carrying amount. And then they have, this is a hotel business, right? So they have cutleries, crockery, and glassware. They don't have any additions during the period, but they have their current year depreciation. So those are the points to be highlighted coming under PPE note. Right. So you need to have a good understanding about the PP note as well, especially when it comes to disposals and all. You can highlight these things when we are doing the answer. Right. So with that, we are moving to the additional information. So you can see the structure of this question after giving the extract of the financial statements and after going through the main notes, P&L related notes, and then especially the PP note is given separately. And then they have multiple additional information, right? So they have actually 11 additional information notes. So we'll see one by one. First, it says the composition of buildings as at 31st March 2026 is as follows. Okay, now we'll go to the buildings. So buildings were there in the PP note, isn't it? Right. So PP note coming under buildings. We'll see now. They have a small table given like this. There are two buildings, Waskadua building and Hikkadua building, right? The purpose is also given. Waskadua building is to be used as the hotel premises, and then Hikkadua rented on 1st January 2026. So this building, Hikkadua building, they have rented it on 1st January 2026, means how many months applicable for the current year of assessment? For the renting purposes, you can calculate these things and just write down when you are reading the question. No need to memorize everything. So you can just calculate January full month, February and March. So they have given this Hikkadua building on rent for 3 months. You can calculate that. And then the cost is given 400,000 and 150,000. Now that makes sense, right? Waskadua building is 400,000, and then it says the construction or the purchase date is 1st July 2021, and it is a constructed building as well. So definitely in the PPE note, it should be there as an opening balance, right? 400,000. So that is what? 400,000. Tally. And then they have one addition 150,000 when they have purchased this. It's a purchased building. 1st April 2025. That means the very beginning of this year, they have purchased this Hikadu building. That is why they have this addition of 150,000 here, 150,000. So information tallying. Right now, you slowly understand what are the things. So whatever the building they have purchased the Hikadu building in the year beginning, and they have rented that building from 1st January 2026. That is for the last 3 months of the year of assessment. Right. And then it says that is about buildings. And then it says all machinery as at 31st March 2025. That means what? The opening, right? We'll check machinery, right? As at 31st March 2025, that means 70,000. So all machinery as at 31st March 2025 were purchased after 1st January 2022. They have purchased it after 2022, except one machine which was purchased in the year 2008. So apart from this 2018 purchased machine, all other machines have been purchased after 2022. What is the cost of that old machine which was purchased in 2018 at a cost of 10 million? So that means out of this 70 million, 10 million machine is old that has been purchased in 2018. And then rest of the machines, that means balance 60,000 has been purchased in 2022. That means after 2022. So when you read these kind of information, now if you don't know, that's okay, but you need to understand, okay, this information is given just to calculate what? Can somebody say the purpose of giving this information, the dates and all? Why they have mentioned the dates of these purchasing and all? What is the purpose? Anyone? Exactly, depreciation. Depreciation in accounting term. What is the tax term? In taxation, we call, your answer is correct, Tirani. Exactly. So capital allowances. So to calculate capital allowances, that is the tax terminology, capital allowances, we have been given this information. So they have already calculated accounting depreciation and they have accounted for. But we need to calculate capital allowances separately. When it comes to taxation purposes, what is the depreciation we are allowing? That means capital allowance. So that is why they have given all this information. Right, so that is about machinery. So as you know, now remember there's one old machine and then there are new machines purchased after 2022. And then we have note number 3, details of the motor vehicles are as follows. So you have the motor vehicles. As you can see, there's one addition as well, and there are some disposers as well. We'll see the breakdown. There are different types of motor vehicles actually, cars, lorries, minibus, and van, right? So cars, acquisition date is given 1st April 2022 and the cost is given 24,000 and the purpose is given for the use of directors. Right. So the cars are there, cars are owned by the company, but the thing is they are used by the directors of the company. So you need to be very careful when you are making the calculation, when you are calculating the capital allowances. So I'm not giving you the answers now. Just think about it. Those cars are used by the directors. And then lorries. Lorries you have purchased in 30th September 2022 and the cost is 11,000 rupees. And the purpose is for transportation of food items required for the kitchen. Basically, this is used for the business purposes, isn't it? Hotels purposes, normal day-to-day operations, they have used these lorries. And you have a minibus and you can see a star mark given as well. We'll read this first. Minibus has been purchased in 1st October 2023 and the cost is 9,000 and that has been used for tourist transportation. So again, tourist transportation can be directly related to the business, right? Because it's a hotel business, tourists are there. So in order to transport these tourists, maybe from the airport to the hotel or hotel to another destination, they have used the minibus. But what is the star point? The minibus was sold on 31st December 2025. So during the year, right, this 31st December 2025 means after 9 months of this year of assessment, they have sold, they have disposed this minibus. So that's a asset disposal. Look at the value of the minibus. 9,000. Cost is 9,000. Now go and check the PPE note coming under motor vehicles. 9,000 cost has been removed. So that is tallying. This talks about the minibus they have disposed during the year. Right. So you need to be careful when calculating capital allowances here. And then you have a van. Van, you have acquisition date 1st January 2025. What is the value? 15,000. That is why that is another addition during the period. 15,000 has been added in the PPE note. So that is why it's a new addition and that has been used for tourist transportation. Right. So that is about the motor vehicles. As you can see, there are new additions as well as some disposals. And some purposes are there. Some are used by the businesses, so business purpose directly. Some are used for directors as well. So we need to be careful. And then note number 4. All cutlery, crockery, and glassware have been purchased on 10th February 2024. Right. So there are no additions or disposals during for the cutleries during the period. They have been purchased on 10th February 2024. So that is about all the PPE items. So we were talking about buildings, machines, motor vehicles, and cutleries separately. And we don't have a separate note for lands. Obvious, that is because we are not calculating depreciation for lands. Same here for taxation purposes. We are not calculating capital allowances as well for lands. Right. We'll move on to the next point as well, note number 5. The composition of bad and doubtful debts is as follows. Now, you can see note number 5. Bad and doubtful debts, 645 likewise. Now, there are two ways you can read these notes, Lamai. There's no one universal correct way to read the notes, but as a practice, when you are reading from the very beginning of the question, sometimes now the first Roman number note we find in note number 1, other income, coming under that you have rent income, refer 8. That is the first note, no? So while you are reading rent income for the first time, you can go to, okay, note number 8. Right, this is note number 8 related to rent income. You can read it. That is also possible. Or else you can skip the notes from the very beginning and then go to the notes and go back to the place where it has been mentioned. Both are fine. That is as per your preference actually. So I thought of, since it is easy to find, I will go from the very beginning. So rent income, note number 8. I'm going to note number 8 I'm reading. So the rent income, there are two parts. First part, a part of the hotel premises. So a part of the hotel premises, when you read this, now you need to memorize, okay, what is the hotel premises? Vaskaduva or Hikkaduva? Hotel premises is in Vaskaduva, right? Okay, that means the Vaskaduva. A part of the hotel premises has been given on rent since 1st April 2025. That means year beginning, to a shopping arcade at a monthly gross rent of 240,000 to provide facilities to tourists. Okay, the rent is there, monthly gross rent is there, the purpose is there, date is there. I'm not talking about the tax implications yet because I will give you a few minutes to think and do the tax computation. So I'm just reading it. So you can process the computer tax implications in your mind. I'm not giving the details now. So you can understand part of the hotel premises given on rent from the very beginning. That means for the whole year, that means 12 months, rent income is there. And then you have the second one, SBH, that means this hotel has rented out its new building in Hikkaduwa. That is correct, no? They have purchased a new building in Hikkaduwa for a monthly gross rent of 200,000 for an office space of an educational institute with effect from 1st January 2026. From 2026, 1st January means last 3 months of 2026, isn't it? January, February, and March. Last 3 months of this year of assessment. So for the 3 months, they have given on rent. That was mentioned in the notes as well, no? Hikkaduwa building rented on 1st January 2026. Right. And then they have another, like within brackets, there's a point. This building was kept vacant since the date of purchase to 31st December 2025. That means what? They have purchased this Hikkaduwa building at the very beginning of the year. 1st January, 1st April 2025. And then since the date of the purchase, they have kept this Hikkaduwa building on vacant. That means they have not used this building for business purposes. And after 9 months, actually, on 1st January 2026, they have rented this building. That is again for an educational institute, isn't it? Office space of an educational institute. So you can think about the tax implications there. That is about rent income. Right. So we have covered that, and I'm going to the question beginning again, rent income covered. And then you have dividend income, note number 9. So we'll go to note number 9 and see what is there. Composition of dividend income is as follows. You have two dividend incomes. Dividend paid by Sakura PLC. That means we have received the dividend paid by Sakura PLC. This is an income. And that Sakura PLC has paid dividends out of the profits of Sakura PLC. So Sakura PLC, that company has paid dividends from the profits of Sakura PLC, 330,000. And then dividends paid by Legrand Hotels Limited, which is a resident company, out of the dividends received from another resident company. That means Legrand Hotels has received some dividend income from another resident company. They have earned dividend income. Out of that dividend income, Legrand has paid some dividend income for us. That is 125,000. Right. So you need to know how to do the tax. Right. That is dividend income. That is also done. And I'm going to the next note. Profit on disposal of minibus, note number 3. Note number 3, we have already read. Now we know what is the minibus, what is the date of the acquisition, date of disposal and all. So note number 3, we already read. That is about this PPE minibus. Okay, that we already know. And then distribution cost, bad and doubtful debts. You have a note number 5, bad and doubtful debts. Note number 5. See, this is the one. Composition of bad and doubtful debts is as follows. You have 3 components there. Trade debts written off, staff loan written off, and then you have a general provision for doubtful debts. So this is a provision. These amounts have been actually written off. So you need to be careful how to do the tax implications. Right. And then you have bad and doubtful debts is also okay. There are no notes, salaries, EPF and all. That's fine. And then my vehicle maintenance. Can you remember I told you to memorize this? Out of 6,000 vehicle maintenance, 2,440 was spent on cars. Now you know the specialty of cars. Cars are used by the business or directors or whatever. Depending on the situation, you need to adjust. And then staff training, you have another note number 6. This one. Staff training expense represent the expenses incurred on a hospitality management training followed by the front office staff during the year. So staff training they have given for those front office staff for hospitality management training. Right. And then you have donations. Donations, note number 10. We'll go and see what is there. Note number 10. Composition of donations is as follows. There are 4 donations. I'm not going to read these donations fully because you know the purpose of donations. Goods donations to an approved charity, donations of school bags to a government school, cash donations to HelpAge Sri Lanka. HelpAge is an approved charity. It's a non-approved charity. And then cash donations to Ministry of Tourism. Those are the sub-elements coming under donations, right? Okay. And then you have donations are also done. Entertainment expenses, note number 7. This one. The composition of the entertainment expenses is as follows. 1.4 million incurred on facilities provided in the hotel for guest entertainment. So you can see there are some guest entertainment. They have spent 1.4 million. And then another 500,000 spent on tour arranged to entertain the selected team in the catering division of the hotel. So they have organized a tour and they have spent 500,000 to entertain these employees, right? That is about entertainment expenses. This one. And then that's it, right? And we'll get to the expenses and all. So now you can see note number 1, 2, 3, 4, 5. We have already read, and then 6 entertainment expenses, rent income, dividend income, donations, and then the last note, income tax paid by SBH on self-assessment basis. For the year of assessment 2025-6 was 5.5 million. So as you know, quarterly, the self-assessment basis, companies have to pay taxes. On that basis, they have paid 5.5 million. So those are the points. Those are the notes we usually get in a company taxation question. Now, I think I could have just while reading the question, I could have just done the complete the answer as well, but I just wanted to give you an overall picture about the question, company taxation question, because this is your first time. Maybe this is your first time doing a company taxation question. So this is how a company taxation question looks like. So one by one, you can read the numbers, read the points, notes, then you can start doing the answer. So calculate the balance income tax liability of Sand Beach Hotel for the year of assessment 2025-2026. So basically you need to do the full tax computation and finally you will get the balance income tax liability. That is the last bottom line of this tax computation. And you are required to show all the workings because definitely in the end exam as well, you will get some marks for your workings. It is very important to show all the workings you have done. Right. So in the past paper, we have taken it from a paper actually. 30 marks were located. This can be 30 or 35 depending on the points. So that is the weightage given for this company taxation question. Right. So we have read the full question. I will give you few minutes, just few minutes. Try to start this, then you can do with me. So you can draw the structure because you know that there's a special structure for this. And then as you know, we are calculating the taxes based on the different income sources. Can somebody please tell me what are the usual income sources? 4 types of income sources in a taxation calculation. It can be individual or company. Main 4 income sources. Yes, I'm getting answers. Correct. Employment income, business income, investment income, and other income. Very good. So those are the four main types of income sources. Now, when it comes to company taxation, what are the income sources? Exactly. We are not considering employment income, isn't it? It's not an individual. So we are not considering employment income. Other than employment income, all business income, investment income, other income we need to consider. So we are going to do the adjustments and do the calculation based on the four income sources. Not four actually, three income sources. Right. So I will give you few minutes, 2 to 3 minutes. Just try to write and do some calculations. So I request you again just to download the question into your device. So take a hard copy because that would be easy for you to develop the answer. You won't be able to read the full question from my screen. Right. So I have written this already. Company name Sand Beach Hotel Private Limited. Income tax computation for the year of assessment 2025 2026. And then I have written the values as well, values in thousands. Right. Okay. So I'm starting with, I don't have employment income. So I'm starting with business income. So number one, business income. Right. So business income is there. Now, the most important thing is in this question, they have already calculated the profits. Basically, profit before tax is already calculated and given to us. So, what we can do is we can start from this profit before taxes, and sometimes there can be adjustments. Sometimes some expenses has have been already deducted from accounting profit as per the accounting treatments, but for taxation those expenses are not allowed to deducted, so we need to add back. අඩු කරන්න දෙන්නේ නැත්නම් අපි add back කරනවා. Some in accounting some amounts have not deducted, but we can deduct in taxation. Likewise, we are going to do some adjustments to the profit before tax. So this is coming under business income. Coming under business income, we're gonna start with profit before tax. So that's why I'm writing profit before tax, and I'm going to do the adjustments. How can I do the adjustments? I'm going to add some items, or I'm going to deduct some items. That means less or deduct some items. So you can keep space. So this space, we don't count and keep space, just randomly keep some space. But remember, uh, අපි අර ඉඩ තියලා අඩු වෙනවට වඩා ඉඩ වැඩි වෙන එක අපිට හොඳයි. If we keep a small space and we don't have sufficient space to write the things, that would be difficult for you. So just keep space. No problem with keeping spaces, additional spaces. Add then less. Right? So that is after adding After adding and after deducting different items, ultimately you can get the final business income value. And then what is the second income source? I'm writing that as well. I'm going to write the full structure. That's how we can do it. Investment income. So if there are any investment income, I'm going to write down the investment income. Right. And then the third one you have, so I'm going to keep, since I read the full question, I know there were no so many investment income like business income adjustment. So I'm going to keep 3 to 4 lines and then I'm going to write other income. Other income. If there are any other income adjustments, I'm going to do it here. Right. So I'm going to keep another few lines for other income as well. And then what is the line item we write? After adjusting, after taking all the business income, investment income, other income, we can calculate the assessable income. Assessable income. Right. Assessable income. And then after that, what do we have? Assessable income means the total of all these three income sources. After that, from the assessable income, we are going to deduct the qualifying payments. Qualifying payments. We are going to deduct the qualifying payments. I think you have done a separate lesson for qualifying payments. So coming under that, we're going to do all the adjustments for qualifying payments here. Right. So after doing the qualifying payments, I'm trying to keep a space there. And then I'm going to write after taking assessable income, after deducting the qualifying payments, I get the taxable income. Next one is taxable income. Taxable income. And then after calculating the taxable income, I'm going to calculate the tax liability. Tax liability. How am I going to calculate the tax liability? I take taxable income, whatever the income taxable, and then I'm going to multiply this taxable income by the relevant corporate tax rate, and then I'm going to calculate tax liability. So after getting the tax liability, whatever the amount we need to pay, on taxable income, we can have some tax credits. I think you know all these things already. Tax credits. Tax credits are there for individual taxation as well. After calculating the liability, now we realize, okay, already we have paid some tax amounts to the government. So we can take them as credits. We can deduct them, tax credits. And then I'm going to keep some space to write the tax credits. And then the final one, balance income tax liability. That means we calculated the tax liability first and then we deducted tax credits. Now what? Now what is the actual balance? Balance income tax liability. So this is how you do it. This is the structure. Now just a matter of writing the numbers and adjusting the tax computation. Right. So we'll go from the very beginning now. Starting with profit before taxes, we'll go to the question. Profit before tax is 66,515. So I'm going to write that. I'm going to use the second column. I'm doing the whole question in thousands, right? Thousands, 66,515. Now we'll go from the beginning. Now we are going to do some adjustments, add or deduct any expenses. Right. There's a message here. Okay, I'll show you the structure again. Business income, and then starting with profit before taxes, and then adding, deducting, and then investment income, other income, total of assessable income, and then we deduct the qualifying payments. We get the taxable income. We calculate tax liability. We deduct the tax credits and then the balance income tax payable. I hope now it's clear. Right. Okay, so if you have any questions, you can actually drop me a text in the Zoom chat because one student saying because of the heavy rain, there's a signal issue and he or she couldn't follow the structure. So likewise, you can ask the questions, no problem. Okay, right. So we'll go to the question. We'll go one by one. Now revenue, cost of sales and everything is there, no problem. Notes are there. We'll try to see the notes. Okay, first one, rent income. We'll start from here because that is the first note we have. Rent income, note number 8. Right. Okay, so the rent income total was there. Now, how can we adjust? First point, look at the first point. As part of the hotel premises, that means the Waskadua building. If you can remember, part of it has been given on rent since the year beginning. What is the purpose actually? There's a point there. This part of this hotel premises has been given on rent to a shopping arcade. And the monthly gross rent income is 240,000 as well. What do you think? Now, this can be considered as, now this rent income, my question is, this rent income can be considered as business income or should be considered as investment income? Usually rent income, dividend income, all these are investment income. No? But my question is, this rent income is business income or investment income? What do you think? Yes, I'm getting questions, getting answers. Exactly. This is, even though this looks like investment income coming because of the rent income nature, this rent has been received to a shopping arcade. Now, that part of this building has been rented to a shopping arcade, and this giving that building part of this building to a shopping arcade is effectively connected to the business. That is effectively connected to the business because we are doing a hotel business. So shopping arcades, if you just think about a hotel, very luxury hotel, in the hotel itself, in the hotel premises, sometimes there are spas, sometimes there are shopping arcades, small shops, handmade shops and some apparel shops. Likewise, shopping arcade has been there. So that is effectively connected to the business because whoever who comes to the hotel, that means tourist or local or foreign tourist, they will go to these shopping arcades and they will purchase things that is effectively connected to the business. So in that case, this rent income can be considered as not an investment income, but a business income. How much is the value? 240,000 is the gross amount, 240,000 per month, right? 240,000 multiplied by 12, 2,880 can be considered as a business income. What is the reason? Reason you can mention this because it is effectively connected to the business, giving that part of this premise, hotel premises, to a shopping arcade. So that is why do we need to do an adjustment now? Now, this has been already, this 2,880 rent income has been already recorded in where? Coming under this other income. Coming under the other income, right? It was there in other income. So you don't have to remove from business income and add it as a separate investment income. You can keep it as business income because it is effectively connected to the business. So no adjustments needed. That is there. So is that clear? Any clarifications on that? Because that is an important point. effectively connected to the business. No need to adjust the business income. It is already recorded in the business income. You can keep it as it is. Right. So, but another point, Lamai. Now, when we are getting this rent income, that means 240 multiplied by 12, that is 2,880. What is the tax adjustment? There's small tax adjustment there. When the person or the company, a person, let's say the people who have taken this shopping arcade, conducting this shopping arcade, this shopping arcade is paying this company, this hotel, 2,880 rupees as rent income. Monthly 240,000 rupees as rent income. When they are paying this rent income, what do they have to deduct? මොනවද අඩු කරන්න ඕනේ? Do they directly pay 240,000 rupees monthly, or do they have to deduct anything? What do they have to deduct? They have to deduct WHTs, isn't it? They have to deduct WHTs, very correct. So when they have to deduct WHT, what is the rate? WHT rate? Basically 10%, isn't it? 10% WHT they have to deduct, and then the balance 90% will have to be paid to the company. So in that case, since this shopping arcade has already deducted 10% WHT from this rent income that should be received by us, that is considered as a tax credit. That is because they have deducted WHT from our rent income and they have submitted. That is why we can already consider that deducted 10% as a tax credit. We have already paid taxes in the form of WHT. So that 10% you need to calculate and write as a tax credit. Right? Write as a tax credit. All right. So write that. Tax credit. I'm going to tax credits. I'm going to write WHT on rent income. Which rent income? Vaskaduva building. Within brackets, I'm writing shopping arcade. Shopping arcade. How to calculate it? So 240,000 multiplied by 12, that is 2.88 million. That was the total amount. So I'm going to apply 10% for this 0.1. 288. Since I'm calculating, since I'm showing rupees in thousands, 288. Be careful. You are calculating the full answer in thousands. So 288 is the WHT. So I'm just writing for my references WHT of 10%. So that you need to consider as a tax credit. It can be in investment income or business income or wherever. That is a classification issue. But you have paid WHT. So you can consider it as a tax credit. Right. Next one. SPH has rented out its new building Hikkaduwa. Right. Hikkaduwa building was a new building, and then monthly gross rent was 200,000. And look at this scenario. They are new building. They have kept vacant since the date of the purchase. If you can remember that scenario, they purchased it at the very beginning of the year. After keeping the building vacant for 9 months, they rented out this new building for an educational institute, office space of an educational institute. Now tell me, is this effectively connected to the business? This rent income, which they are going to earn for 3 months? What is your answer? Is this effectively connected to the business? No, right? Because this building has been given for an office space of an education institute, not related to hotel business. In that case, do we have to consider this one? Yes, right. We have to consider this one not as a business income because this is not effectively connected to the business. This as an investment income. So this rent is an investment income, not a business income. So already 200,000 multiplied by 3, right? That is 3 months, no, last 3 months. That was recorded in the business income. That is coming under other income. So you need to remove that 600,000 first. So I'm going to business income. And then already this is included in 66,515. So I'm going to deduct it first. So rent income, Hikaduwa building. I'm going to deduct it first. 200,000 multiplied by 3. So 600 I'm going to deduct. And then what? I have to add this 600,000 as an investment income because we are considering this rent income as an investment income. So I'm writing rent income, Hikkaduwa building, that 600,000 as a investment income. So look at what we did. We removed it from the business income because it is not a business income, and we have considered it as an investment income, 600. Right. What is the next tax adjustment on this one? Now you know. What is the next tax adjustment? So monthly they have paid 200,000 rupees, right? This education institute has paid 200,000 rupees to this hotel business. When they are paying 200,000, WHT is paid when the amount is higher than what? When the amount is higher than how much? Can I have an answer? WHT should be deducted when that rent income is higher than how much? Monthly? Monthly how much? 100,000. 100,000. Yes, your answers are correct. When the monthly rent income is higher than 100,000, ලක්ෂයට වඩා වැඩි නම්, that tenant has to deduct WHT, right? So that is why there are some other conditions as well. But here, 100,000, 200,000 is more than 100,000. In the previous scenario also, monthly 240,000. So it's obviously higher than 100,000. They have to deduct WHT. So in that case, in these 3 months also, this tenant, this education institute has deducted WHT. So coming under tax credits, again, I'm writing WHT on rent income. That is not Vaskaduwa now, Hikkaduwa. Hikkaduwa, that is for education institute. How can we calculate? Monthly, 200,000 multiplied by 3, that is the total rent income. From this, what is the percentage? 10%. That means 60, they have deducted WHT. So we can claim that as a tax credit. That is how we write it. Okay? Right. Uday sir, are you there? Hello, Uday sir, can you hear me?
It's possible.
Yeah. So we have a question in the chat box. I have
Yes.
shared that in the chat box again as a comment message. Rent income එකකින් 125 deduction එකක් වෙන්නේ investment income වලදී විතරද?
Investment income වලදී විතරයි. Investment income වලදී විතරයි. ඇයි දන්නේ මේ දුවර කැවුවේ? වෙන මොකක් හරි ඒගොල්ලන්ට අවස්ථාවක් තියෙනවද? හෙලෝ අහලා
Hello.
බලන්න වෙන මොකද ඇයි දන්නේ ඒ ප්‍රශ්නේ ඇහුවේ කියලා
ඒක
ඉන්වෙස්ට්මන්ට්
තමයි.
ඉන්කම් වල
Relief
සීටස්
එකක් ගැන හුවේ or the club 24714. If you have clarification, you can ask the question again, Puta. Right. Okay. We'll continue. Right. So I hope that's clear. That is how you understand whether effectively connected to the business or not. Based on that, you can do the adjustments. So I'm going to highlight this. We are done with rent income. Okay. I'm going back to the notes. Rent income is completed. Right. Dividend income. Refer to note number 9, dividend income. So we'll see dividend income. Right. Dividend income, as you can see, there are two dividend incomes, right? 330 and 125. Now, what is the income source? Dividend income is business income or investment income. As you have learned, this is clearly investment income. So already we have considered this dividend income as in the accounting purposes other income. Other income ඇතුළේ තියෙන්නේ. So we have recorded dividend income in this profit before tax. That is in the business income. So first thing you need to do is remove that. Deduct that dividend income from the business income. So I'm writing dividend income. Dividend income. How much is the total of dividend income? 330 and 125, 455. So I'm going to deduct that 455 from the business income first, because we are not considering that as a business income. Now what? Dividend income should be considered as an investment income. Now we'll take one by one and see. Okay, the first one is dividends paid by Sakura PLC. If you can remember, out of the profits of Sakura PLC, Sakura PLC has paid us dividends 330. What do you think? What is the tax adjustment here? Do we need to write it separate again, coming under investment income? Thing is, I think you have discussed these things in the lecture. When a company is paying dividends out of its profits, when the company is paying, that company is deducting WHT. That Sakura PLC is deducting WHT from the dividend income they pay us. That WHT is considered as final WHT. So no need to deduct taxes again, because that is the final WHT. So because of that reason, we are not writing this 330 again. See, this 330 is net, already WHT deducted. So when Sakura PLC is paying us, they have deducted WHT. So we are not taking this 330 again into tax consideration. So, but remember, when you are writing it, since this is an exam, write that as investment income and write the reason for not considering and make it zero. Show it as zero. So I'm writing dividend income. You also can write dividend income paid by Sakura PSE. It is final WHT. They have deducted WHT and that is final. No need to deduct taxes again. Because of that, it's zero. Because of that reason. Right. Next one, dividends paid by Legrand. Now, Legrand has paid us dividends out of dividends received from another resident company. Legrand has received dividends from another resident company, and then again from that dividend income, Legrand is paying us dividends, 125. What do you think? What is the tax adjustment here? Dividends paid by Legrand. I will just write it. What is the tax adjustment? Now, when a company is paying dividends, out of the dividends received from another resident company, that dividend income is tax exempt. Tax exempt. So that is the reason we are not considering it here. Tax exempt. So again, zero. We are not considering that as an investment income here. right? It is exempted. Because when they are paying, originally they have deducted WHT, they have paid WHT and all. So tax exempt. Right. So that is about dividend income. What we did was, first of all, we deducted it from the business income, we removed it, and then we were planning to add them as investment income, but due to two different reasons, amounts are zero. Okay. So with that, dividend income is also done. And then the cash price. What do you think about this? This cash price, they have Ceylon Tourist Board has identified SPH as the best hospitality service provider of the year. 2.6 million. What do you think? Taxable or not? Taxable or not? Do we need to tax this or not? Taxable income or not a taxable income? What do you think? Hurry up and give me the answers. Do we need to tax this cash price income or not? Taxable or not? It is in the business income already because it is in other income anyway. Yes, taxable. That is taxable because they have received a cash price. It is taxable. So it is already in the business income, isn't it? Already there as an business income. So no need to adjust again because it should be taxed. So let it be there. So we are not going to do any adjustment here. So that is also done, right? Taxable. And then profit of disposal of minibus. Okay, this is something we have to do some workings here. I will take it separately, right? Profit on disposal. Now, as you can remember, there was a minibus, and that minibus has been disposed during the year. When the assets are getting disposed, PPE items are disposed, accounting purpose, we are calculating profit on disposal, right? But accounting purpose calculation, profit on disposal is not allowed to tax. We have to remove that. And for taxation purposes, we need to calculate that profit again based on tax principles. So because of that, we have to consider a working there. I will come to that point later, but we'll keep it. Right. And then bad and doubtful debts. Bad and doubtful debts, we are moving to distribution expenses. Refer note number 5. Right, coming under bad and doubtful debts. We have trade debts written off, staff loan written off, and a general provision. Now, what do you think? What are deductible? What can be deduct under taxation and what is not deductible? Actually, trade debts written off, deductible or not? Can we deduct this 500 rupees as a deductible expense? Is this allowed to deduct coming under taxation? Yes, trade debts written off, that is related to business. So we have written off some debtors, that's allowed. What about staff loan written off? Allowed or disallowed? Disallowed. Disallowed. We cannot deduct staff loan written off. And what do you think about general provision for doubtful debts? Can we deduct provisions in taxation? No, not allowed. Disallowed. So in that case, these altogether 645 already deducted from already considered and deducted from the profit before taxes. But when it comes to taxation, only 500 rupees is deductible. Balance 145,000 not deductible. So there are different methods you can adjust this. One method is already 645 deducted, but actually 500 is only deductible for taxation, 145,000 not deductible. So we have to add back this 145. It is not deductible. We'll do that first. So I'm going to business income and I'm going to add general provision for doubtful debts and the staff loan written off. Total is how much? 100 and 145. Total is 145. That is one way of doing the adjustment, Lamai. Or else you can see, sometimes if you want, altogether you have 645 bad and doubtful debts now. This has been deducted. So what you can do is, you can altogether add back 645. So you are removing the accounting treatment completely. You add back 645, and then whatever the deductible amount you are going to deduct. That means only 500,000 you can deduct. No? So you are going to deduct, coming under deductions, you deduct 500,000. But the net impact is what? 645 added, 500 deducted means 145 added. So net impact can be this 145. Both methods are correct, Lamai. Both methods are correct. Right? So that is the bad and doubtful debts. Okay, this is also done. Next one. Advertising. Advertising coming under distribution cost. This is okay. This is deductible because advertising can be spent for hotel promotion purposes. Deductible, allowed to deduct. No need to do any adjustment. Right. Now we have depreciation. We have depreciation. Now, as you can see, as we discussed, this is accounting depreciation with regards to distribution expense, distribution cost, maybe distribution vehicle depreciation. And if you can remember, apart from this depreciation, we had another depreciation coming under admin expenses as well, because admin related PPE items are there. Depreciation of those PPE items, those depreciation. So overall, anyway, accounting depreciation is not allowed to deduct. But for taxation, we need to calculate that depreciation again based on tax principles, which we call capital allowances. So what is your first step? You need to add back. Now, depreciation has been already deducted from business income, already deducted. Now we need to add back accounting depreciation. So I'm writing depreciation. What is the amount? Now my point. What is the total amount of depreciation I need to add back? What is the total amount I need to add back? There's another point there. Quick to tell me. How much is the total depreciation I need to add back? Total amount of depreciation expense. Here we have distribution related depreciation 10,500. And then again, I have coming under admin expenses depreciation 33,875. Is it 44,375? Do you all agree with me? Addition of 10,500 and 33,875. Do I have to add that 44,375 as the depreciation or something else? Actually, remember, when you are calculating the total accounting depreciation to be added back, if you just add this 10,500 and 33,875, that is wrong. Because the reason is this depreciation is for distribution related aspects. This depreciation for admin related PPE items. Lamai, when it comes to cost of sales, sometimes there can be other machines or equipments used for manufacturing or service providing purposes, and that overhead cost, that depreciation is considered under cost of sales. So when you see the cost of sales figure, you can't see the depreciation amount went into cost of sales. Because of that reason, if you just take depreciation of distribution and admin together as 44,000, that's completely wrong. Then from where you need to get this actual depreciation expense for the period? That is from the PPE note. Remember, very careful. So depreciation you have during the period, you need to consider these totals: 21,000, 12,000, 10,000, and 6,000. So just calculate and see the total of the depreciation expense. I think that is, since I have it, the total 50,375. That is the total of depreciation expense. It is anyway higher than that previous 44,000. So I'm going to add back the total depreciation 50,375. That is the total of accounting depreciation. I hope that's clear. Right. Now what? So we added that account in depreciation. Now we need to deduct. We are allowed to deduct only the capital allowance. So we can do a working separately. Working number 1 for capital allowances. Working 1, capital allowances. Right. So now asset by asset, that means asset class by class, you can calculate the capital allowance. So I'm taking buildings first. So we are not depreciating, we are not calculating capital allowances for lands. I'm taking buildings. Right. What are the buildings we have? In the PP note coming under additional information also we have Vaskaduva and Hikaduva. So Vaskaduva building and Hikaduva building. Right. Vaskaduva and Hikaduva. What are the cost items? We need to have the cost as well. Vaskaduva building is 400,000. Right? 400,000. How can we calculate the capital allowance for this Vaskaduva building? What is the rate? 400,000 divided by 20 years. So we can calculate capital allowance for 20 years. So we divide 400,000 cost by 20 years. Can we deduct? Can we consider the full year? Because yes, this has been purchased in 2021. So still we are talking about 2025, 2026 year. We have more time. We can go until 20 years. So I just divided 400,000 by 20 years. This is the capital allowance. Write this. And then Hikkadu building. What do you think? How can we calculate the capital allowance for Hikkadu building? What's your answer? Hikkadu building cost is 150,000. This has been purchased during the year. So during the year, they have purchased the building. And first 9 months, they have kept the building on vacant basis. They have not used this. After that, at the end of the year of assessment, that means last 3 months, they have given this Hikado building on rent. Can we deduct capital allowance for this Hikado building? Ideally, no. The reason is first 9 months they haven't used the building for business purposes. They have kept the building on vacant. So first 9 months, no. And also for the last 3 months, actually, they have given this building for a rent purpose, for rent that is effectively not connected to the business as well. Right? Because of that reason, we are not calculating capital allowances for this Hikado building. So that is the reason 0. Remember the reasons very carefully. Because of those 2 reasons, we are not calculating capital allowances for Hikado building. Right. So buildings done. Next asset class is machinery. Now you are familiar with the notes, no? Machinery. Right. Now, if you can remember machinery, all the machines were purchased after 2022. Just see from 2022. This year is 2021, 2022, and then 2022, 3, 2023, 4, 4, 5, 5, 6. Now, can we calculate capital allowances? Yes, we can calculate capital allowance, but one machine was there. That is an old machine. It was purchased in 2018. So we have two types of machines, right? Old machines and the new machine. Old machine. So I'm writing it as old machine, 2018 machine. And then the new machines. Tell me whether we can calculate capital allowance for this old machine. Old machine cost is 10 million. That means 10,000. Then what about the new machine cost? Or the total of the machines 70,000. We had total 70,000. Previously, we calculated that. So out of 70, 10 million is old, 60 million is new machine. Can we calculate capital allowance for this old machine, 2018? We can't because 2018 means already finished 18, 19, 19, 20, 2021, 21, 22, 22, 23. This is 25, 26. So no capital allowance. Already we have deducted capital allowances. What about the new machines? 60,000. That is from 2022. So we can still calculate capital allowance. Capital allowance we can calculate for 5 years for machinery, that is 20%, right? So 60,000 divided by 5, 12,000 we can calculate. So buildings, what was the rate? We divided by 20 years, that means 5%. Machinery, 20%, that is why we divide by 5 years, right? 12,000. So that is about machinery. And then the next asset class is what? Motor vehicles. So write that, motor vehicles. What are the types? We have 4 types of motor vehicles: to cars, lorries, minibus, and van. So I'm writing cars, lorries, minibus, and the van. If I take the values, cost items, 24, 11, 9, 15. Right, these are the values. Right. Now, can we deduct capital allowances for cars, Lamai? What do you think? Can we deduct capital allowances for the cars? Now go back to your question and read the purpose of cars. Cars are used by, very good, the answer is correct. Cars are used by directors, not for the business purposes. In that case, can we deduct capital allowances if we are not using the cars for the business purposes? No, we can't. So in that case, since they are used by directors, no capital allowance, 0. Within brackets, you can write used by cars, used by directors. No CA. What about lorries? Can we deduct capital allowances for lorries? Lorries were purchased in 2022. So 2022, 3, 4, 5, 6. Still we have time to deduct capital allowances. And the lorries are used for food item required for kitchen transportation. So no problem, connected to the business as well. We can deduct capital allowances. So I'm just dividing 11,000 by 5, 2,200. Again, the capital allowance rate is 20%. Right. Next one is what? The minibus. Right. Now this minibus is a special scenario. No? Minibus has been disposed during the year. During the year, they have disposed it. What is the date? After 9 months. After using for 9 months, they have disposed it. Now, can we calculate capital allowance? Can we claim for capital allowances for this disposed minibus? Yes, answer is correct. We can't because when we are disposing an asset for the disposal year, we can't claim capital allowances. That is the reason. So minibus, even though we have used for 9 months, disposal year we can't claim. Lamai, when it comes to purchase of assets, irrespective of the month or the date, we can claim capital allowances for the whole year. But on the opposite side, for the disposal year, we can't claim capital allowances for the whole year. Because of that reason, no capital allowances. So you can write no CA since the disposal year. These are for your notes actually. And then we have a van. Next one. Van was purchased during the year. No problem with the number years. And then it is used for tourist transportation. No problem. 15,000 divided by 5, 3,000. We can claim 3,000 capital allowances. Right. So that is about motor vehicles. And the last category is cutleries, crockery, and glassware. I'm going to write the classification. We have one number there. Total is how much? Total of cost is 20,000. 20,000 is the total cost, and they have been purchased on 2014, 2024. Still, we have time. Again, the capital allowance rate is 20%. So I'm going to write the cost as 20,000, and I'm going to divide 20,000 by 5, 4,000. Capital allowance rate is 20%. Right. So we have considered all the PPE classes, PPV items, and then I'm just taking the total of all these capital allowances. It is like 41,200. 41,200. So I'm writing total capital allowances 41,200. Now I'm going to deduct that 41,200 from the business income. So accounting depreciation we added back, and then we are going to deduct 41,200 as the capital allowance. Like this. So I hope you are clear with the capital allowance calculation. And since it is a working, I'm going to refer to the working. Always you can do this when you are writing answers in the exam as well. Refer working 1. Okay? Right. Capital allowances. Now, Ramai, since we were talking about depreciation, capital allowances and all, can you remember we skipped one uh, profit on disposal of minibus? We didn't do this adjustment. No, we can do this now because we already know the depreciation and all. Now we'll do this. It's a separate working number 2. Working number 2. Usually we call it balancing allowance calculation. When you have these kind of disposals and profit on disposals, in tax terms, we call it balancing allowance. Right. Now this is about the minibus. First of all, what is the first step you have to do? This is my accounting profit on the disposal. Is this uh, allowed to be taxed when it comes to taxation? No, we need to remove that accounting profit first. We can tax only the tax purpose calculated profit on disposal. So that is why, first of all, you can remove this profit from the business income because already this profit 850 is included in the business income. So I'm going to go to the deductions, less, coming under that, profit on disposal of minibus. That is 850. I'm going to deduct. So I have deducted that. I have eliminated that profit. Now I'm going to calculate the actual profit based on the taxation. Right. To calculate the profit, we'll see, first of all, how much is the sales proceeds? How much they have earned by selling this minibus actually. We have the profit now. We have the profit as 850, but we don't know the sales proceeds they have earned by selling this minibus. How can we calculate that? Now we have the cost of that minibus. Cost of the minibus is how much? Coming under motor vehicles, they have disposed a cost of 9,000. Okay, cost was 9,000. So I'm writing cost 9,000. And then at the time of disposal, how much was the accumulated depreciation? Accounting accumulated depreciation 4,050. So 4,050. That is the that is the accumulated depreciation value. Right. So when you deduct 4,050 by 9,000, 9,000 minus 4,050, 4,950 is the carrying value of that minibus at the time of disposal, right? At the time of disposal, the value was 4,950. So while having 4,950 carrying amount, they have earned a profit. How much was the profit on disposal they have calculated? They have calculated a profit of 850. So they have earned 850 profit means how much is the sales proceeds? What is the selling price? 4,950 plus 850, 5,800. So they have earned 5,800 by selling this minibus, the sales proceeds actually. So I'm taking that one first. Okay, 5,800. Right. Now we know the accounting purpose carrying value, no? But we don't know tax written down value. Tax written down value means the carrying value of an asset based on tax purposes. Carrying value means in accounting. Tax written down value means in taxation. So we'll try to calculate tax written down value of this minibus at the time of disposal. So I'm writing cost. Cost of this minibus was 9,000. We already know that. At the time of disposal, what was the accumulated balancing allowance? That means so far how much they have deducted for capital allowances throughout the period. So accumulated balancing allowance. So accumulated capital allowances actually. We'll write that's that. මේ වෙනකොට කොච්චරක් tax ඒ කියන්නේ capital allowances අඩු කරලා තියෙනවද? What do you think? They have purchased this minibus. If we check the details, minibus was acquired on 1st October 2023. That means in the year of assessment 2023, 2024. We write that. First year is 2023, 2024. Right. And then that is the acquired year. And then 2024, 2025. So they have claimed capital allowances for this year, 2023 4, and then 2024, 2025. And then what is the next year? 2025, 2026. 2025, 2026. This is this year. This is the disposal year. Do we claim capital allowances for disposal year, this year? No, we don't. So far, for how many years we have claimed for capital allowances? for 2 years. That means we have claimed how much? 9,000 is the cost. If we have deducted this by 5, that is for 1 year. Likewise, we have claimed capital allowances for 2 years. That means 3,600, right? So for 2 years, we have claimed capital allowances. With that, what is the tax written down value? That is based on taxation purposes. What is the carrying value of this minibus? 9,000 minus 3,600, 5,400, right? So that means 5,400 is the tax written down value. How much is the profit? So they have sold actually 5,400 tax written down value minibus at a price of 5,800. In that case, tax profit, that means gain actually, is 5,800 minus 5,400, 400. That is the profit. This is the profit as per taxation principles. This profit actually you can calculate, you can take it. You can add this as 400. You can add this 400 as, you write it, balancing allowance. And we have a working there. Because of that, working number 2. Right. So we removed accounting profit and then we calculated tax profit and then we added that again 400. Are you clear? Any doubts in that process? Both in capital allowances and the balancing allowance. Any issues? Right. Okay, let's go back to the question. So we have completed now profit on disposal as well. I'm going to highlight that. Depreciation, of course, we have done. We calculated capital allowances and all. Now, coming back to admin expenses, salaries and wages, those are deductible. We can deduct these expenses. EPF, ETF, deductible. No need to do any adjustment because already these expenses have been deducted. Depreciation we considered, we calculated capital allowances. Utility expenses deductible, we have already deducted. So no need to do any adjustment. Now, what about fine paid to the tourist board? What do you think? What is the tax adjustment? Is this deductible? Is this deductible? Can we deduct this from taxes when calculating fines? You can't, right? You cannot. So in that case, fines paid to the tourist board, this has already been deducted from the business income, that is from the profit before taxes. That means you need to add back. So fine paid to the tourist board, the value is 375, adding back 375. All right. And then that is all that is adjusted. And then you have the next one, vehicle maintenance. Now, usually in the ordinary course of the business, vehicle maintenance you can deduct. This 6,000 can be deducted, allowable, deductible. But the case is this includes 2.44 million, which is spent on cars. Now you clearly know these cars have been used by the directors. We even didn't claim for capital allowances for these cars. So can we deduct the vehicle maintenance? Are we allowed to? Is it allowed to deduct the vehicle maintenance spent on these cars used by directors? No. So even though this has been deducted already, we cannot, it is not allowed to deduct. That means we need to add back. So that's why vehicle maintenance, 2,440. This is for specifically for cars, not all other vehicles. This 2,444 cars. That is not allowed. That is why we need to add back. That is also done. Next one is staff training. Staff training, point number 6. Okay, if you can remember, there was a staff training, and that expense represent expenses incurred on a hospitality management training, followed by the front office staff during the year. Now, what do you think? Is this deductible or not? This, how much is that? This 900. Can we deduct this or not? What is your idea? This is incurred on a hospitality management training followed by the front office staff during the period. This 900,000 can we add? Sorry, can we deduct? Exactly. Very good. This is deductible because for the improvement of the front office staff, we have actually spent this. The hotel has spent this for hotel hospitality management training for the benefit of the hotel. So deductible. This training is deductible. So already we have deducted. That means we don't have to do any adjustment. Deducted. Right. Deductible. Other expenses. We are moving to other expenses. First one is donations. Right. Now, when it comes to donations, when you hear the word donations, you need to remember we are talking about qualifying payments. So there are so many different types of donations we can consider under qualifying payments. So the first thing is, now the donations have already been deducted coming under other expenses. No, 2,100, they have deducted these donations. So other coming under other expenses, even though it has been deducted, we can't consider it there. We have to take it to qualifying payments. Coming under qualifying payments, after considering certain criteria, we can decide whether to deduct or not. So the first point is donations they have deducted from the business income. This one you need to add back. You need to add back the donations. So I'm adding back donations. Total donations is equal to 2,100. Yes, I'm adding that 2,100 here. Okay, now fully accounting treatment is reversed. We have added back. Now I'm going to qualifying payments. So that is why we need to write the full structure. Then it's easy for you, right? So qualifying payments. Now we'll consider coming under qualifying payments. We'll take one by one and write. Okay. Note number X. That means 10. Composition of donations is as follows. First one is what? Goods donations to the approved charity. Goods donations to approved charity. Lamai, is this allowed or disallowed? Can we deduct this 200? We have donated some goods to this Fritzko Children's Home, which is an approved charity. Can we deduct goods donations to approved charities? I'm writing it. Goods donations to approved charity. I need your answer. Deductible or not? Allowed or not? Remember, goods donations to approved charities not allowed. So this 200,000 can we deduct? We can't. Not allowed. So you write it and you write not allowed. Next one. Donations of school bags. Again, school bags means goods, isn't it? Donation of school bags to children's in Lunugama Government School. What do you think? Can we deduct this or not? School bags donations to Lunugama Government School. Can we deduct this or not? You have learned this. This is deductible. Anything that means goods or cash paid to government or government related institutes, 100% allowed. If you are donating cash or goods to government or government related institutes, 100% allowed. That means we'll write it separately, like here, school bag donations to Lunugama Government School. This is, you can write 100% allowed. That means you can deduct. The value is 600. So 600 you can deduct. So I'm writing it in the first column. Next one, cash donations to Helpage Sri Lanka. My Helpage Sri Lanka is a famous, popular, approved charity. Now my question, can we allow cash donations to approved charity? Yes, we can allow, but there are some conditions. We can allow, there are some conditions. Anyway, goods donations to approved charity not allowed. That is direct. But cash donations to approved charity, I'm writing it and I'm mentioning it for the calculation. The value is 300. We'll write it so far we can write 300. That is not the final amount. We need to consider some other aspects, but we'll do 300. We might deduct. Next one, cash donations to the Ministry of Tourism. As I mentioned you earlier, cash or goods donations to government or government related institutes, 100% allowed. So Ministry of Tourism is a government institute. Cash donations to Ministry of Ministry of Tourism, 100% allowed, 1,000. Fully allowed. Right. Now, what is this? What about this 300, Lamai? We have to do a small working in this 300. How can we do that? Now, that working is different from individual taxation. Those ratios are different, but we'll see. For companies, what is the numbers? What are the proportions we have to consider? If you can remember. First of all, now after considering all these government related aspects, you deduct it 100% allowed. Goods donations to approved charity not allowed. So when we have cash donations to approved charity, we take the amount like this and we need to calculate 1/5 of assessable income of this company. Still, we haven't calculated the assessable income, so that number is pending. But once we get that assessable income, we need to calculate 1/5 of that assessable income value. So we'll write that amount here once we complete it, right? So, and then you need to compare this, right? You need to compare this with the upper limit of how much? 500,000. You need to take 1/5 of the taxable income and you need to consider it with 500,000. You need to take the lower value between 1/5 of taxable income and the upper limit of 500,000. So you consider them. We'll write it like this. You compare these two and you take the lowest value. Next one, after considering the lowest value between 1/5 of taxable income and the upper limit of 500,000, then you again compare with the actual amount. Actual amount is how much? 300, because we have 300, right? This is the actual amount, 300. You take the lower of these two values, that amount will be deductible. Right. So we'll do it once we have the taxable income. For now, you can memorize, okay, this is the process we need to follow. Right. Okay. So donations we have considered. Once taxable income is done, we can complete there. Fully considered. Donations, fully considered. Right. Next one, entertainment expenses, point number 7. Right. Composition of the entertainment expenses is there. 1.4 million incurred for guest entertainment. So in the hotel there are guests. To entertain the guests, this hotel has spent 1.4 million. Lamai, can we deduct this entertainment expense? Is this allowable or not? Already we have deducted. I'm asking, is this allowed to deduct? Exactly. Deductible. Now, I heard one situation when it comes to your employment income also. Employment, entertainment expense කියන එක දැක්ක ගමන් ළමයි ඒක not deductible වෙන්නේ නැහැ. So the entertainment expenses sometimes based on the purpose, some are deductible. This is one of the situations. So this is for guest entertainment, that is for business purpose. This is deductible. No problem. You can deduct it. So no need to do any adjustment. We have already deducted. But what about this 500,000? 500,000 spent on a tour arranged to entertain the selected team in the catering division of the hotel. This one is purely employee entertainment. This is not allowed. 500,000. So we have already deducted. That means what? We need to add back this 500,000. Staff tour entertainment. This is not allowed. This 500 is not allowed. Right. That is about entertainment. That is also done. And then we have the next one, provision of lawsuit. Lamai, straightforward. Provision of lawsuit has been deducted already, but provisions are not allowed. Provisions are not allowed to be deducted, disallowed. So in that case, provision for lawsuit 100, you need to add back. Provision of lawsuit 100, you are going to add back because those provisions are not allowed to be deducted. And then you have annual get together expenses of the staff 900. What do you think? Similar to entertainment expenses, isn't it? These annual get together expenses are not allowed to be deducted. So I'm adding back 900 annual get together expenses. 900 not allowed. So I added it back. Right. So far we have considered all these items: revenue, cost of sales, gross profit, no need to adjust anything. So coming under all these other income, distribution, admin, and other expenses, we have considered sub items separately. So we have highlighted. It's when you are also doing this kind of a question, you can put a tick once the items are done. So we have considered all these things. PPE note we considered for depreciation separately. And then this buildings note we considered for capital allowances. We considered machines for capital allowances. We considered motor vehicles, and then we calculated the profit on disposal of the minibus as well. We calculated capital allowances for cutleries, likewise, staff training, entertainment, rent income, dividend income. We have considered all. Donations we have considered, but we have a small part remaining. We'll do that. And then the last point, income tax paid by SBH on self-assessment basis, 5.5 million. Okay, now here the company has already paid some taxes based on self-assessment basis. Clearly what? Clearly a tax credit. So we can claim that, take it as a credit when we are calculating taxes, self-assessment payments. So you can write self-assessment payments, 5.5 means 5,500. You can take it as a tax credit. You have already paid taxes. Right. Now, shall we take the totals and finish this? I'm taking the total of additions here. 57,335. If you have the numbers or different numbers, just let me know. And then I'm going to deduct 43,105. I'm going to deduct that number. So I'm going to, since this is an Excel, I can remove the unnecessary space. Right. So after adding 57,335 to 66,000 and then deducting 43,000, I have the business income. That means the adjusted business income as how much? 66,515 plus 57,000 minus 43,105, 80,745. Just see whether your numbers are correct. This is the business income. Business income. And then I take the investment income total. Investment income total is 600. That's correct. There's only one line item. And then, did we have any other income? No, right? We didn't have any other income sources in this question. So it's a 0. In that case, how much is the total accessible income? We add the business income, 80,000, and we add 600 investment income. Altogether, we didn't have other income. If we have, we need to add that as well, like this. So altogether, 81,345, that is the total of accessible income, like this. Right. So when you go down, you can see there's a pending part in the donations part, qualifying payments. Now we need what? 1/5 of the accessible income. We need that. Now we can take. I'm going to take here 81,345 divided by 5. 1/5, no. 16,269. Lamai, what is the lowest value out of 500 and 16,269? Obviously 500. That is the lowest value. Then I'm comparing this 500 with what? With this actual amount 300. Actual amount is 300, no? This the cash donations to approved charity. We take whichever is lower out of these 500 and 300. What is the lowest value? Actual 300. So I'm going to take the answer as 300, right? Lowest value. Right. So with that, we have 300, 600, and 1,000. These are directly fully disallowed, fully allowed. So I'm going to take these things 1,900 as the qualifying payments. This is a minus figure, isn't it? Minus figure, 1,900. Right. So when we have 81,345 accessible income, and then we have 1,900 as the qualifying payments, what is the final taxable income? It's 79,445, right? It's 79,445 taxable income. So this is the amount we can apply our corporate tax rate. So how much is that? 79,445 coming under tax liability. We have to multiply this by the corporate tax rate 30%. So when we apply 30% to 79,445, the answer is 23,834. Right? This is the answer. Tax liability. Tax liability as per the calculation. But we don't have to pay 23,834 because we have paid some amounts already, WHT, your self-assessment payment. We'll take the total of tax credits as a minus figure. 5,848 we have already paid. In that case, 23,834 plus 5,848, altogether only 17,986 is there as the balance income tax payable. This is the balance income tax payable. Right. This is how you do a normal company taxation question, Lamai. Any issues or any clarifications on the process? I have a question. I actually received it earlier. Can you explain bad and doubtful debts again, miss? Okay. Now, there were only three elements coming under bad and doubtful debts. Altogether 645 they have deducted as bad and doubtful debts, but apparently that total amount cannot be deducted for taxation. But the things we can deduct is for taxation, trade debts written off we can, that is allowed. But staff loan written off, that is not allowed. General provision for doubtful debt, since it is a provision, not allowed. So, since we have already deducted 645, we can add back how much? Staff loan and the general provision, 145, we can add back. 500 is allowed. That is how you do it easily. Are you clear? Any other questions like that? Are you clear about the whole process? I think someone is asking the two reasons for not claiming capital allowances for those second building. Second building is Hikadu building, no? Hikadu building, why we didn't calculate capital allowance? First reason is this building we purchased at the very beginning of the year. First 9 months, we didn't use this building for business purposes. So we are not calculating capital allowances. And on the other hand, last 3 months, we have rented this building. Renting is not a matter, but we have rented this building for an external, for a purpose effectively not connected to the business as well, for that education institute. So in that case, we are not claiming capital allowances for Hikkaduwa building fully because we have not used that Hikkaduwa building for any hotel business purposes. We can claim capital allowances only if we have used only if we have used that building for business purposes, hotel business purposes. So that is why we are not claiming capital allowances. Are you clear? Uday sir, anything to be added, sir? There are no other any other questions.
Miss, that particular student who asked about the 25%, was there any other queries
No,
coming from him?
no, sir, no.
The point is now all the students should know this 25% allowance on investment is given only for individuals.
Yes.
Investment allowance, not for the companies. That is we really don't know why that question was raised.
I think he or
Anyway,
she has thought we are going to give that 25% for companies as well. No, sir, that might be the
maybe
case.
no, it is not given for the companies.
Yes.
So if that is the case, Miss, we'll conclude the class
Yes, I will
and
quickly
also,
share the OTP, sir. Then they can share
yes,
the attendance as
yes,
well, no? Yeah, give me a
okay,
second.
okay.
Ramai, you can, those who have joined, quickly log into your exam unit site and be ready to type the OTP. Right. You can mark your attendance. OTP is 870177. Can you see a session?
Yeah, I can
Is it
see
possible?
it, but can you just refresh the summary, Natasha, please?
I think session is not visible to them. We'll see, sir. Give me a second. Now check whether you can see this session. I have added you all again. Right. Thank you. Mark your attendance. 790381. Right. Right. I think you have marked your attendance. I hope you have all marked your attendance. I don't know why it's 58. There should be only 55 students. 59.
Okay, now
Yeah.
that time is sufficient, no, miss?
Yeah. We'll close the sessions.
Yes.
Right. Okay, sir. So with that, I think we can wind up the session if you don't have any questions. So you can practice this. You can take this question as a practice question and you can redo it again and get ready for the exam also because you will get a similar kind of a question for your end exam as well for 30 or 35 marks. So, yeah. Okay, sir, do we have any other uh, things to be mentioned?
In the next Friday, we will be having a physical class,
Yes.
and thereafter, we will be having again the final online class for VET, Value-Added Tax, done by
Yes.
Nadeek, sir. 27th is the last day, I suppose.
Yeah.
Okay.
Right. So with that, we'll wind up session, Lamai. Good night and thank you very much. Thank
Good
you,
night,
this
miss.
as well. Good night.